Good afternoon, students. Over the last couple of weeks, we studied about uh, income statement. Okay, we studied about profit and loss account. Okay, so we studied about profit and loss statement and how to record them. We learned about gross profit. We learned about net profit. Okay, and we learned about all of them over the last couple of weeks. And now from the statement of financial, I mean the from the statement of from the profit and loss statement. Now today we are moving on to the statement of financial position. Okay, in the profit or loss statement, we assess the financial performance of the business. Okay, we assess the financial performance of the business. Okay. Now, today we are going to the statement of financial position where we assess the financial position of the business, how its assets are, how its liabilities are, how much they are, and what is the equity position. Likewise, they will be reflected in the statement of financial position. Okay, so today we are going to learn about statement of financial position. So after preparing the income statement, the trial balance is only left with the balances of balances of the accounts of assets, liability, and equity. The statement that is prepared to include the balances of assets, liabilities, and equity is called the statements of financial position. This is also called as the balance sheet in the past. This shows the business organization's financial strength and ability. The information given in the statement of financial position will be helpful for the economic decision making of stakeholders of the organization, like owners, creditors, and financial institutions. Now, if we come back, we had the trial balance, right? We had the trial balance. Now, from this trial balance, what do we have? We have few things. We have the accounting elements. We have income, okay? We have expenses, balances of the income, balances of the expenses, and then we have assets. We have we have liabilities, okay? And then we have equity, okay? We had trial balance and we had all these five types of accounting elements in it: income, expenses, assets, liability, and equity. Okay, now if we look at this income and expenses, we made profit and loss statement. Okay, profit and loss statement. So over the last couple of weeks, we studied about this profit and loss statement, where we address the income and expenses. Now we have another part remaining, right? Now we have another part remaining. We have assets, liabilities, and equity remaining. Okay. For these, including these, we will be creating, or we will be preparing, the statement of financial position. Okay, so we have the trial balance. Trial balance included the final balances of income, expenses, assets, liabilities, equity, or the accounting elements. So we took income and expenses and we prepared profit and loss statement, which included the gross profit and net profit. And then now we are left with assets, liabilities, and equity, where we will be preparing the statement of financial position. Okay, now the statement of financial position, okay, the statement of financial position is also called the balance sheet. Okay, it's also called the balance sheet. Now what this does is It shows the strength and ability of the business. Okay, strength and ability of the business. And all the stakeholders of the business will use this to assess the business. Stakeholders like owners, creditors, and financial institutions. Okay. So, as of a particular date, assets, liabilities, and equity of a company possess can be also expressed by the accounting equation, which has already been discussed. The, the accounting equation can be depicted as assets is equal to equity and liability. Okay, now this thing we have already learned. Okay, now let's say we are being asked to sort of like indicate the relationship between assets, liabilities, and equity of a business. How do we do that? We prepare the accounting equation. Assets is equal to equity plus liability. Okay. It is simple as that. Asset is equal to equity plus liability. This is the accounting equation. So values summarized for assets, liabilities, and equity are shown in the statement of financial position on a rational basis. එතකොට අපි දැන් මේ කතා වුණානේ මේ statement of financial position කියන එක we discuss about this statement of financial position. Now this relationship is actually being depicted or indicated in these statement of financial position or the balance sheet. The statement of the financial position includes, as I said, assets, liabilities, and equity position of the business. Okay. Uh, okay. So let's take a couple of minutes and let's write down the note. We can start from the statement of financial position, and we can prepare put the subheading or put the main heading as a statement of financial position, and then you can start writing down these points in the point form. Okay, so take a couple of minutes to write them down. Okay, now we are moving on to the first or the main one of the main elements in the statement of financial position, or the first uh, element in the financial position. So assets. So we have three items in the statement of financial position: assets, equity, and liability. So assets, we already learned about the assets in when we learned about assets in grade 10. Okay, we already learned about assets. Okay, asset is a resource controlled by the business as a result of past transaction and from which future economic benefits are expected to flow into the business. Okay, so this definition we already learned. Okay, if we look at asset, asset is what? Now asset is a resource. Okay, and it is controlled by the business. Okay, it is controlled by the business as a result of past transaction, as a result of past transaction, and from which future economic benefits are flowing to the business. Okay, so we should know it's a resource controlled by the business. This is a main point. Okay, and it will generate future economic benefits into the business. Okay, it will generate future economic benefits into the business. So in grade 10 we studied about this, and now when we talk about assets, okay, when we talk about assets, okay, assets have two forms of asset categories, or we can say asset have two main types. Okay, they can be divided into two main forms. What are they? Non-current assets, non-current assets, and current assets. Okay, non-current assets and current assets. Now, this formation of two categories or this division of two categories is done based on the liquidity. Okay, it is done based on what? It is done based on the liquidity. Okay, these two categorization based on the liquidity. So non-current. So let's first talk about current assets. Okay, current assets. Current assets are expected to make into cash or expected to liquidate within 12 months. Within 12 months. Okay, so they have less than 12 months of life. Let's say something like stock. Okay, we will sell them in less than 12 months. Okay, stocks we will sell them in less than 12 months. Let's say something like cash. Cash is already liquid. Let's say something like debtors. Okay, they should be turned into cash or liquidate within or less than in less than 12 months. Less than 12 months. Okay, and then we have the other form, which is non-current assets. Now non-current assets, any asset that do not fall into current asset will be considered as non-current assets. Okay, any asset that do not fall into the category of current assets will be fall into non-current assets. So ideally, non-current assets will have more than 12 months of life. Okay, non-current assets, they will have ideally more than 12 months. More than 12 months. Okay, for example, what? Land, building, machinery. Okay, so those are the examples. So we have assets as the first item, and there we have two categories, non-current assets and current assets. Okay. Okay. So we are going to try out an example. The accounting period for Nadika's business from the 1st Jan 2025 to 31st December 2025. As at 31st December 2025, the following assets existed. Closing stock is their land and building, their furniture, trade debtors, cash, machinery, delivery of motor vehicle, cash in hand, fixed deposit. Two fixed deposits are there. Okay. Now, in this example, okay, I want you to categorize them based on the non-current asset and current asset. And I want them to order based on the liquidity. Less liquid, highly. Less liquid, high liquid. Okay. I want you to put them into 1, 2, 3, 4. I don't know how many items there will be. Then 1, 2, 3, 4. Okay. I want you to take a couple of minutes and put these assets into non-current assets and current assets and order them based on the liquidity. Okay. So less liquid assets, you put it first, and high liquid asset, you put it last. Okay. In current assets also, you put the higher less liquid asset first and high liquid asset later. Okay, so take couple of minutes and do this exercise. Okay, now we are going to put these items or these assets into the non-current assets and current assets in a order. Okay, now it is not just in the order, we are also putting it to sort of like part of the financial statement. Okay, but the essence of it is identifying it based on the liquidity. So let's firstly look at the liquidity. Okay, now we have to first identify the non-current assets. Okay, we have to first identify the non-current assets. Okay, now what are the non-current assets here? Let's look at them first. Non-current assets here are land and building. Okay, land and building, furniture. Then current assets are trade debtors. Okay, then cash at bank. Okay, machinery is a non-current asset. Machinery, delivery motor vehicle. Those are non-current assets. And then we have cash in hand, which is a current asset, cash in hand. And then there is a fixed deposit of 5 year. 5 year FD, that is a non-current asset. And 6 month FD is a current asset. Okay. Now we are going to put this into two categories based on the liquidity. So non-current assets. Non-current assets, land and building is usually less liquid. Okay. Land and building. Then we have furniture, which is less liquid. Then we have machinery. Okay. Machinery is more liquid than land, building, and furniture. And finally, we have the motor vehicles. So motor vehicles we can easily sell. Right. Now then we have the next part. We have another part which is 5 year FD. 5 year FD. Okay. 5 year FD also we have to consider it as a non-current asset and it has a higher liquidity. If you look at the liquidity, it has high liquidity, but it is a non-current asset. Okay, so land and building, furniture, machinery, motor vehicle, and finally 5 year FD. Okay, now now we have to identify the current assets. Okay, current assets are asset that has less than 12 months of liquidity. Okay, or else they are supposed to make it into cash within 12 months. Okay, less than 12 months, less than 1 year in simple. So we have what? We missed one thing. We have the closing stock also. Okay. So we have closing stock. Okay. And then we have trade debtors. Okay. Then we have three things: cash at bank, cash at hand, and 6 month FD. Now 6 month FD is less liquid compared to cash at bank and cash at hand. Okay. 6 month FD. And then we have cash at bank. Cash at bank is less liquid compared to cash in hand. Cash at bank. And finally, we have the cash in hand. Cash in hand is the most liquid form of asset. Cash in hand is the most liquid form of asset. Now, if you look at closing stock, it is less liquid than trade debtors because you have to sell it. You have to sell it to someone and then you have to turn it to cash. But trade debtors, you have already sold it. Okay, now you have to just convert into cash. Then you have 6 months FD. 6 month FD fixed deposit is less liquid compared to cash at bank or cash at hand or cash in a current account because you have to keep it for 6 months. Then you have cash at bank. Okay, and finally you have cash at hand, which is more or higher liquid. Okay, so these are the two forms of assets, non-current asset and current assets, and they are being categorized based on the liquidity. Okay, once you have this, you can put it in a statement. You can put it in a statement like this. Okay, so business of Nadika, we call it statement of financial position. Statement of financial position. Statement of financial position. Statement of financial position as at 31st December 2025. Right? And then you will put it under, you will put it in a format like this. And you will write non-current assets. And then current assets. Okay? Like this. Okay, so you have land and building, furniture, machinery, and motor vehicle. So their values are 2,80,000, 20,000, 60,000, and 400,000. I wrote these first because I wanted to emphasize the liquidity. Okay. Altogether, they will add up to 7,60,000. Okay. And then we have the fixed deposit, which is 5 year, and which is 50,000. And total of that 8,10,000 is the non-current asset. Then we have the current assets, closing stock, which is 30,000. Trade debtors, 45,000. Fixed deposit, 6 month, 20,000. Cash at bank, which is 15,000. And cash in hand, 80,000. Altogether, they total for how much? 1,90,000. So altogether, we have assets worth 1 million in the business. We have assets worth 1 million in the business. So take a couple of minutes and write them down. So as we discussed over the last couple of slides, okay, now if you look at these assets, or if you look at this presentation of assets, they are done based on the liquidity. Okay, they are done based on the liquidity. So how we did it? Less liquid asset on top and high liquid asset on bottom. So we had first coming in non-current asset, and 1, 2, 3, and then we had current asset, 1, 2, 3. Okay, that is how we did it. Okay, so the assets of a business are presented in the order of the liquidity in a statement of the financial statement. Okay, so as I explained, these assets are placed based on the liquidity in the statement of financial position. The ability to convert an asset into cash with a minimal loss in the short period of time is defined as liquidity. Okay, let me explain it like this. Okay, let me explain it like this. Now we have asset. Okay, and most liquid thing is cash. Okay, most liquid thing is cash. Now, if we can convert this asset into cash, okay, into cash with a minimal loss, okay, with a minimal loss, and within the shortest period of time, we call it a high liquid asset, or we call it a liquid asset. The assets with the less liquidity are shown in first. Okay, now this one, this non-current assets are less liquid. Okay, these are high liquid. Okay, so assets of the business are presented in the order of the liquidity in the statement of financial position. See, it is done based on the order of the liquidity. Okay, the ability to convert an asset into cash with a minimal loss, asset into cash with a minimal loss in a short period of time is called the liquidity, or is defined as the liquidity. The assets with less liquidity are shown first. Assets with less liquidity are shown first. Okay, so that is something which is very important when it comes to assets. We need to know how liquid they are in order to place them in the statement of financial position. So first we place non-current assets, and then we place the current assets. So even within the categories of non-current assets and current assets, there is a order of liquidity. For example, land and building are less liquid compared to motor vehicles. Motor vehicles are less liquid compared to something like 5-year fixed deposit, which is 5 year. Okay. And on the other hand, if we take the current assets, stock is a current asset, but it is less liquid, even though it is liquid compared to a non-current asset. It is less liquid compared to something like cash in hand or cash in bank. Okay, which we discuss here. See, closing stock, trade debtors, fixed deposit 6 month, cash at bank, and cash at hand. So if someone asks us to rank them based on the liquidity, what is the most liquid one? Most liquid one is this one, then this, then this, then this, and then this. Finally, closing stock among the current assets. Okay, among the current assets. So among non-current assets, fixed deposit, which is 5 years, is higher liquid compared to something like land and building. Land and building is the least liquid form of asset. Okay, so we have these assets which are being recorded in the statement of financial position based on the order of the liquidity. Based on the order of the liquidity, and less liquid assets are shown first. Less liquid assets are shown first. Okay, so take a couple of minutes and write this slide. Okay, I will re-explain it. Okay, I will re-explain. Now we have statement of financial position, right? We have statement of financial position. There we include three things. What are they? Assets, liability, and equity. Now we are talking about these assets. Okay, we are talking about these assets. Now, when we talk about assets, assets have two forms. First one is current assets, let's say. current asset. The second one being non-current asset. Okay. If we can convert an asset into cash in less than 12 months, we call it a current asset. If it is more than 12 months, we call it a non-current assets. So when we take the statement of financial position, we record these assets based on what? Based on liquidity. We record assets based on liquidity. Now, when we are being told liquidity, now it comes to the question, what is liquidity? Okay, we have a statement of financial position. We record the assets in them, and we record these assets based on the liquidity. So someone can ask, what is liquidity? Okay, what is liquidity? So liquidity is if you can convert an asset into cash within a short period, in with minimal loss, okay, we call it what? We call it a liquid asset. Okay, we call it a liquid asset. Okay, now based on this, non-current assets are what? High liquid or less liquid? Non-current assets compared to current assets. Tell me. Non-current assets compared to current assets, they are less liquid. Okay, non-current assets are less liquid compared to current assets, because in the definition itself, it says it takes more than 12 months to convert a non-current asset into cash. Okay, so non-current assets are less liquid and current assets are current assets are high liquid. So in the statement of financial position, we record assets based on the liquidity. If that is the case, what should we record first? We should first record non-current asset, right? And then we record current asset. Then we record current asset. Now, even among this, what is the issue or what is the concern? Okay, we have to record non-current assets also based on the liquidity. In the statement of the financial position, here, see. Okay, in the statement of the financial position, we are recording assets based on the liquidity. Okay, so we record non-current assets first and current assets later based on the liquidity, and we record less liquid asset first. Okay, we record less liquid assets first. So firstly we record non-current assets and then we record the current assets. Now even in the non-current assets, we have subcategories of assets. For example, land and building, vehicles, 5-year deposit, likewise. In the current assets also, we have subcategories. For example, stock, debtors, and cash in hand. Now they also have to be recorded based on the liquidity, and we have to record less liquid asset first. Okay, the assets which are under non-current assets and assets which are under current asset have to be recorded based on the liquidity, and less liquid asset have to be recorded first. Okay, less liquid asset has to be recorded first. So in non-current assets, usually what? Land and building come first. They are less liquid. Then we have vehicles. Then we have long-term deposits. Long-term deposits. See, land and building is less liquid compared to vehicles. And long-term vehicles are less liquid compared to long-term deposits. Okay. And when we take the current assets, okay, stocks come first. They are less liquid. They are the lesser liquid one. And then we have the debtors. Okay. And finally, we have cash. So cash is high liquid. Now stock is less liquid compared to debtors. Debtors is less liquid compared to cash. So less liquid assets are recorded first. Now, if someone asks what is liquidity, then we learned here. See, if someone can convert an asset into cash with a minimum loss within a short period, we call it a liquid asset. Okay. So we have the statement of financial position. We record assets, liabilities, and equity in it. So firstly, we are going to learn about assets. Assets, we have two forms, current assets and non-current assets. Current assets are the assets that can be converted into cash in less than 12 months. Non-current assets are assets that take more than 12 months to convert into cash. Okay. So in the statement of financial position, we record the assets based on the liquidity and we record less liquid asset first. Less liquid asset first. So if someone come and ask you what is liquidity, liquidity is ability to convert an asset into cash within a short period with a minimum loss. Okay, that is what liquidity is. So non-current asset is less liquid compared to current assets because in the definition itself, it take more than 12 months to convert into cash. So when we go into the statement of financial position, we record non-current asset first because it is less liquid. Okay, and then we record current assets. So even inside the categories of non-current asset and current asset, we record these items based on the liquidity. Based on the liquidity. Okay, so usually land and building is less liquid compared to vehicles. So we record it first, and then we record vehicles, and finally we record something like long-term fixed deposits, which are more liquid. And after that, we record current assets. So among the current assets, we firstly record the less liquid current asset first. Okay, high liquid current asset is recorded at the last. So stocks are less liquid compared to debtors, and debtors are less liquid compared to cash. Okay, so that is the logicality behind this recording of individual items or individual assets. So I hope you understand that. So you can take a couple of minutes to write the slide. So likewise, we learned about the assets part in the statement of financial position. So we learned about current asset, non-current asset, and we learn about recording as assets in the statement of financial position based on the liquidity and recording less liquid assets first. Okay, so we learned almost everything about assets. So I want you to do activity 5 as the homework. Okay, so I want you to do it as a homework, activity 5. Okay, it's very easy. So you will have to show the categorization of assets as current and non-current assets in an extract of a statement of the financial position. Okay, so we learned about assets. Okay, we learned about assets, and now we are going to learn about the equity. Okay, now we are going to learn about the equity. Okay, so once organized, so we are learning about equity. Once organization uses its assets to settle its external liabilities, the residual is called as the equity. So in simple format, like if we draw an equation for that, okay, So equity is equal to what? Assets minus liability. So this will be the equity. Okay. Equity belongs to owners of the business. The part of the assets that belong to the owners of the business is termed as equity. Equity is increased as a result of net profit and new capital introduction. It is decreased as a result of net losses and drawings. Okay. Okay. Now, if we take equity, okay, if we take equity, we have few things that can impact to equity. Okay, we have few things that can have an impact to equity. Okay, if we take net profit, okay, if we take net profit, new capital, okay, this will increasing in net profit or increasing in new capital will increase equity. Okay, will increase equity, will increase equity. Okay. On the other hand, if there is any drawings, okay, if there is any drawings or net losses, okay, increasing in net losses and increasing in drawings will decrease equity. Okay, it will decrease equity. It will decrease equity. Okay, so to equity we have few items that will have an impact: net profit, new capital, net losses, and drawings. So if there are net profits or new capital, then equity will go up. Okay, equity will go up. On the other hand, if there are net losses or drawings, equity will come down. Okay, equity will be decreased. Okay, so based on this, we are going to try out a small exercise. Okay, going through the example given below, understand how the equity is calculated. Okay, so I want you to try it out. Okay, so accounting period starts on 1st January 2025, ends on 31st December 2025. Okay, so we have capital. Okay, capital at the beginning is there, which is 1,50,000. Withdrawal means here what? Drawings. Okay, so cash drawing of 12,000 and withdrawal of goods 8,000 is there. Then net profit for the period, net profit for the period will be 50,000. Net profit for the period is 50,000. So now what are we supposed to do? We are supposed to calculate the capital at the end. Okay, at the end of the period. Right. So take a few minutes and try it out. You have the capital at the beginning, you have the withdrawals, and then you have the net profit. Okay, so take a couple of minutes and try it out. Okay, so we have some points. Okay, so we are going to calculate the uh, equity of the business. Okay, so first we are starting off with the capital at the beginning. Capital at the beginning. Okay, which is 1,50,000. Then we add two things. So what will increase the equity? net profit and new capital. So net profit and new capital will increase the equity. Okay. So we will add, we don't have any new capital being introduced, but we have a net profit. See, so we add the net profit. We add the net profit. Net profit is 50,000. So we add the net profit and we get 200,000. Okay. Then we deduct drawings. We have a cash drawing of 12,000. Okay. And we have goods drawing worth of 8,000. Okay. Which is altogether 20,000. So when it is being deducted, how much we have? We have 1,80,000. Okay. So the final capital or the equity at the end of the period is how much? 1,80,000. Okay. So this is how we calculate the equity of a business when we are being given the capital at the beginning and the other components like new capital, withdrawals, net profits, and net losses. Okay. So with that, we will conclude that part, and I want you to do activity 6 as a homework. Okay. So you can take a couple of minutes. You can take a couple of minutes to write it down, and you can do activity 6 as homework. Okay. So with that, we will wrap off today's session, and thank you so much for your presence.